I'm going to go over a few things with you as you get ready to do the T accounts for June MixMax. So here we've got your MixMax materials. If you turn the page, you'll see for Intermediate 2, I've actually listed out all the accounts and described, what causes them to go up and down. So bad debt expense causes the allowance for doubtful accounts to go up, and if we write off actual accounts, it causes it to go down. So I think you'll find this to be a great review for you. So if you forget, just come back to these beginning pages and you can sneak a peek. Now, what's new in June MixMax is this account deferred taxes payable, or deferred tax liability. And we saw that in my prior recording on depreciation. So it's going to go up when we defer taxes, right? Those are our cash savings, our short-term cash savings. And then we'll turn around when we have a reversal of that and we end up paying it back. And again, we've got all of these accounts. Now, right now, this bonds payable, we're not going to see that for a while. So you're not going to see that yet. So don't worry about it. Okay, now that I've got my screen turned around, let's talk about business activities. And this is just a review. We saw this back in Intermediate 1. So we know that a company can get started in business or expand their operations. There's two ways of financing. We can either issue debt, specifically long-term debt, or stock, equity. So financing transactions are cash flows with either long-term debt or it's transactions with stockholder equity. So we finance with long-term debt and stockholders' equity. So any cash flows, whether it's cash coming in or cash going out for these items, gets categorized as financing activity in our three categories for cash flow. Remember, we have the three categories: financing, investing, and operating. Okay, so that's financing. Then money comes in and we invest it in the business by buying these long-term assets. So investing activities are cash flows with long-term assets. Either cash is going out to buy them or cash is coming in because we sold those. Those are investing activities. Then everything else gets categorized as operating because we use those assets to generate sales. Sales, after we factor in expenses, results in net income, or profits, which we hope we have. And if we do have profits, that will make our investors and creditors, or satisfy them, make them happy. Okay, so everything else is operating. So revenues minus expenses are all our normal operating activity. And if I want to look at balance sheet accounts, then the only thing left on the balance sheet then are our current assets and current liabilities. So our current assets and current liabilities are connected to revenue and expenses on the income statement. Okay, so let's turn the page and look at the next screen. And we saw this screen in Intermediate 1. So here I've listed out, the income statement, typical income statement accounts, revenue, less all these different expenses. And those are sales will result in cash coming in. Cost of goods sold is going to cause us, we had that because we bought inventory. Rent expense because we paid cash for rent. Salaries and utilities, we have to pay cash for those. Interest, we pay cash. Taxes, we pay cash. So we know that most of these income statement accounts result in some sort of cash flow. Cash flowing in or cash flowing out. And what we saw in Intermediate 1 is that sales is connected to these two accounts on the balance sheet, and through our T account analysis, we can run sales through these two accounts to solve for cash collected from customers. Cost of goods sold, we ran it through inventory to solve for purchases. We ran that through accounts payable merchandise to solve for cash paid to suppliers. Rent expense, we weaved that through prepaid rent in the double T account analysis to get cash paid for rent. Depreciation expense is connected to accumulated depreciation, and recall, we never pay cash for depreciation. It's just an accounting entry representing using those long-term assets. These payables, we ran them through some sort of payable account to arrive at the cash paid. Interest expense, we go through interest payable. Let's cross that out for now. We will see later on where we'll have that premium and discount, but not yet. And so then we have cash paid for that. What's new here in June and Chapter 11 is that we have two accounts now related to income tax expense. the payable and the deferred tax liability. We weave it through those two, and we're going to get cash paid for taxes. So when we want to solve for indirectly, so that's kind of what we did using the direct approach. Then the indirect approach, which is the shortcut, if you recall, the first step was to take net income, and then we removed anything that was non-cash, which in this case was depreciation. So we took out depreciation expense from it by adding it back. Step number 3, we removed any gains or losses because those are non-operating activity. If we sell property, plant, and equipment, those are investing activities. So we took net income, removed anything that's not going to be a cash flow, removed anything that's not going to be an operating activity because we only want cash from operations. So we removed gains and losses. The fourth step is that when we looked at these accounts, current asset, current liability, current liability, current asset, current liability, current liability, current liability. Notice I didn't circle deferred taxes yet. Those were all current assets and current liabilities. So then we factor in the changes in the current assets and current liabilities. However, what's going to be new now, starting in June, is that we also going to factor in the change in this deferred tax liability count, even though often it is not a current liability. So we'll look at the change in that. And so then step 1 through 4 gives us cash from operations. Okay, let's look at the next page. Actually, I'm going to skip over that for now. Okay, so here's our statement of cash flows. We know for the direct method, we solve for these and these 3 categories. And the way we solve for investing and financing under both methods is the same. What's different in how we problem solve and report are these operating activities. So in Intermediate 1, we had 5 steps. Now we have 5, but they're very similar. It's the same. We start with net income. And so we start with net income. We're going to remove anything that's non-cash. We're going to remove anything that's non-operating. So remember, we have revenues minus expenses. That gives us net income. So if I want to remove an expense, remember I have to add it back to cancel it out. Normally on the income statement, right, gains are positives, losses we subtract, and all of those to arrive at net income. So if I want to remove a gain, I subtract it. And if I want to remove a loss, I got to add it back to cancel it out. Okay, we also know that these revenue expenses are related to most of the current assets and current liabilities on the balance sheet. So we just net the change in those in, did current assets go up? Or did, like accounts receivable went up, maybe $200 or whatever it was. So we just demonstrate, it went up or went down and how much. The next thing, what's new, is this step number 5. Now for now, we're not going to deal with the premium and the discount, but you do need to factor in the change in the deferred tax liability account, and then we get our cash from operations. If you want to backtrack on this page, I went ahead and showed investing and financing activities. On the income statement, for property, plant, and equipment, if we do have property, plant, and equipment on the balance sheet, then I'm going to expect to see depreciation expense. Also, if those accounts go down, well, why would PP&E go down? Well, we must have sold it. So I would expect to see a gain or loss on the income statement. If we have long-term debt on the balance sheet, I would expect to see interest expense. If I don't, something's wrong, right? Somebody made a mistake on their income statement. Now, if the long-term debt goes down, I would expect, likewise, interest expense to go down. And then I have common stock and retained earnings. If we issue common stock, cash is going to come in. If retained earnings goes down for something other than a net loss, that's because we paid dividends, and that's a cash flow. So here's the typical investing activities. Remember, on the prior page, I said those are transactions with long-term assets. So that's mostly going to be, it could be property, plant, and equipment, but it can be other long-term assets as well. And financing has to do with long-term debt and or stockholders' equity. Okay, so that gives you kind of a starting point for the June MixMax. Now, what we're going to see when we do MixMax is you're going to start to see more and more of these question marks on the balance sheet and the income statement and cash flows. Now, just heads up, have you thought about if you cannot solve for these question marks, where might you find them? Well, first off, as your teacher, I very much hope you can solve for those. For instance, if you know total liabilities and equity, you should know that's going to be total assets. But what if I can't get these? Well, ending June is also the beginning balances for July. So if you do get stuck on these for the balance sheet, just peek ahead to July 1 and you can see those numbers. But before you go do that though, make sure you really try it, because you learn so much about how the financial statements are interconnected by solving for those. Okay, so you're going to solve for those. By the way, this is going to tell you, I think I talked about it earlier, one of these assets gets sold, and so you're going to have to factor that in to the June. Okay? All right, I think we're at the end of that. Good luck with June, and I'll be going over that in another recording.